Good afternoon and welcome to the mortgage market update for May 2022. My name is Richard Purnell from the Mortgage Home and we are your buy-to-let mortgage experts. As usual, let's get straight into Market Watch. What's been going on? Well, this has been at the top of the slide for feels like forever. Bank of England rate during the early part of May went to 1%. And what I'm asked on a regular basis is, will it increase further? Well, I guess the short answer is, my personal view is yes, it will. One of the main drivers for pushing the BOE rate up is its impact on inflation, to trying to curb that. And frankly, when the main man, the captain of the ship, the governor of the Bank of England yesterday, which was 16th of May, used the word apocalyptic when talking about inflation, that's not a good thing, isn't it? So we're in the thick of it right now. Inflation's going to get higher. I think we're at 7 to 8% at the moment. Bank of England talking about 10% plus. So yes, I do believe that rates are going to increase and therefore mortgage rates will continue to ratchet up. So let's go on to some more positive news, shall we? Okay, what's caught my eye this month? Well, Newcastle, good old Newcastle Building Society, have removed their minimum income requirements. So who's this going to benefit? Who will it help? Well, it's you first-time landlords or landlords that are buying their maybe not first, but second or third properties. So it's you guys I'm talking to when and who might benefit from this when it comes to Newcastle. There has been, certainly with the high street banks and building societies for years, a ridiculous, in my opinion, arbitrary minimum income requirement before you can get your buy-to-let mortgage. In other words, the Bank of Building Society says, thou shalt earn over £20,000 to even apply to us. Has no bearing on what you're looking to do. You might be getting £1 million buy-to-let mortgage. Oh, but you've got to earn over 20 grand a year because we've got to tick that particular box. Good old Newcastle, you've ditched it. More building societies have been doing the same. I think I mentioned on an earlier mortgage update that Leeds Building Society had also ditched that ridiculous policy requirement. So good on you both. And hopefully it will be more to come. And that'll help you guys that particularly, like I say, if you can achieve that 20 grand of income, and that could be that, yeah, the employment that you've got just doesn't pay that higher salary. But I see so many self-employed people where your profits are under 20K, or you're a limited company director and you're taking a salary, but you've no need to be pulling dividends out because, for various reasons. You might be, I don't know, getting directors' loans, repayments back. That's not classed as income. So as far as the world and HMRC are concerned, you've only got your director's salary of 12K. Well, you wouldn't have been eligible with Newcastle last week. This week you are. So happy days. Okay, sticking with the Building Society theme. Leeds again. So they've reduced their stress rate calculation on 5-year fixed deal. Bit of a mouthful. What the hell does that mean? And again, who will this benefit? So what it means is that now, essentially, you can borrow more than you could have done last week when it comes to Leeds Building Society. The calculation that they use is now more generous. So we're talking about buy-to-let remortgages in particular. Also purchases, I guess, that where it really affects people, if you as a landlord have got low yielding properties, and if you don't know what I mean by that bit of jargon, essentially it's the gross rent. So the gross annual rent. So we're talking about family lets here, not talking about holiday lets, okay? Family lets. That gross annual rent divided by, or as a percentage of, the value of the property. What figure does that come out at? A low yielding property, 3, 4, 5% perhaps. A mid-yielding property, 5 to 8 or 9%, and a high-yielding property certainly getting into double digits. That's a general, sort of rule of thumb, I would say, from my experience. So the low-yielding properties, these are the ones where you're going to struggle to either get that 75, 80% borrowing for your purchase, or indeed, if you're refinancing to pull out that equity from your capital growth, again, you may struggle. So you really need to be focusing on your 5-year fixed deals where the formulas are more generous to start with. And as I pointed out here, Leeds Building Society are making their formula even more generous. A really good buy-to-let broker should understand the nuances of these calculations and how they work. So make sure that you're talking to a good buy-to-let broker when that's an important criteria. Okay, I put a section on that solicitors here. Now, it's been an issue for certainly all of last year, but in 2022, in my opinion, and as far as my company is concerned, this issue is not going to, in fact, it's getting worse, that the service levels of solicitors, I am generalizing, and there is some great ones still out there, but they're really struggling and suffering when it comes to providing really good service. And of course, the impact is on you guys who are trying to get your purchase over the line in a reasonable time, or indeed you remortgage to get onto that next deal and either save that money or, again, release the equity. Whatever the reason is, usually you want to make sure that you've completed in a good time. It's been such an issue for our clients that we've done quite a big study on this and looked at all the solicitors that we have used throughout the last 12 months. And by that's not us necessarily recommending them. These are, client-driven solicitors, or lenders might have appointed them. And on average, it's taken from offer to completion. So that's the timeline that we focused on, not application to offer. So you've got your mortgage offer out. That's when the time starts ticking. How long is it taking to then get that deal over the line from offer to completion? And the answer is, at the moment, as an average, 66 days. So that's 2 months. Now, it's not a figure to be proud of, but it's something that we've wanted to drill into so that we can then start to look at those solicitors that are really dragging the feet, that are not either able to cope with the volume of the business, and are either not brave enough to turn that tap off. And actually, I applaud some solicitors. Certainly, there's one or two in our local area that actually shut their doors and said, we're not taking on any more business. You might think, oh my God, what on earth's going on here? But I think that's a brave decision to do that, so you can at least keep the service levels to a decent point until you can perhaps recruit or sort that blockage out. There are others, however, that don't. They just keep taking on more and more business, and they're just getting a poor reputation. By the way, the average might be 66, but we've highlighted internally, we won't mention any names on this video, solicitors who are taking 80, 90, 100, and the highest one, and these are averages, by the way, 120 days. That's 4 months after an offer's out to get over the line. And clearly, we need to be informing our clients so that we can stay clear of those solicitors going forward. And actually, also on the flip side of that coin is which solicitors are getting offer to completions. The lowest we were seeing, again, as averages, were 30 to 40 days, which feels to me more acceptable. So be mindful of solicitors. And also, when it comes on here, I said on here, free solicitors. So when you're doing a remortgage only, not purchases. So if you're doing a buy-to-let remortgage, it's not unusual that a broker can get you a mortgage deal that has free solicitors as part of the incentive, the benefits. This is not limited company buy-to-lets, by the way. That would be unusual to get free solicitors. So I'm talking about in a remortgage of a buy-to-let in personal name. So if you are offered free solicitors in the past, you wouldn't have blinked at that. That's great. Free solicitors, let's crack on. But because of what I've said, that the solicitors now are really grinding to a halt, then there are some lenders, quite a reasonable number, that will offer an alternative. They'll offer an alternative. So it'll be the same deal. It'll be the same rate. If there's an arrangement fee, it's the same arrangement fee. But instead of offering free legals, they'll give you some cash back instead. Now, it won't be a king's ransom. It might be up to 500 quid or so. But if you are desperate to ensure that you want to get over that completion line in the quickest time for your remortgage, then that might be something to consider. And if your broker doesn't mention it, but you know that you've got a strict deadline to hit, then if there is a cashback option, then because you can then use your own solicitor rather than the one appointed by the bank or the lender, then that could make all the difference in the world. Okay, Last thing on this screen, which is tenant versus ownership mix. What on earth am I talking about? Okay, so if you are thinking of buying a buy-to-let that is an ex-council, ex-local authority property, then prick your ears up at this point, because there's a number of lenders that get their surveyors. Obviously, the bank or the lender will instruct their own valuers to go out and value that property. We all know that. One of the things that you probably don't know is happening behind the scenes is that that valuer might be asked by that lender to look at the mix within that postcode and surrounding area, the mix of tenants versus owner occupiers. And why is that important? Because if that mix is more than 50% tenant, then there are some lenders that will just decline the case. They will just decline the case. So there is actually a way of checking this information. I'm not sure if the valuers use this same website, so please take it with a little pinch of salt, but it would give you an indicator. And that is a website called streetcheck.co.uk. You go onto that website, you tap in the postcode of the property you're looking to buy. Once you've done that, there's a page that is titled housing, and on that then tab, there's a bit of analysis of the physical number of owners in that postcode, and also how many tenants, and literally just do the maths. And if there's more than 50% tenants, then that's worth again flagging up, to your broker, or get your broker to do that check. Particularly if you're buying, as I say, an ex-local authority property, because if we're going to a lender who has this rule in place, then you'll have wasted time, possibly money, to find that once the valuation's done, you get declined on that reason. Reason. There are lenders that do not have that policy rules, so don't be too concerned. But again, do the planning, do the prep, so that you don't get caught out by that. Okay, green mortgages. Talked about it before, talked about it last year, but man, this thing is going to get bigger and bigger as an issue, and it's going to have potentially an impact on every single landlord in the country. So I make no apologies for dusting it off and talking about it again, as I'm sure we will as we get towards 2025, which you might think, oh my God, Richard, that's 3 years away. Why on earth are we talking about it? It's because it's such a big issue. So please take a couple of minutes to just listen as to why it is such an issue for something that may not change for another 3 years. So right now, the government are considering putting a legislation in place so that when we get to 2025, if you want to let out a property, so it's a new tenancy from that date, if your property that you're wanting to rent out has an EPC rating of D, E, F, or G, you'll not be able to let that property. All of a sudden, it's no longer an income-bearing property until you can upgrade the energy efficiency of that property and get it in the A to C bracket. So it's massive. If that becomes legislation, then it's going to affect, I saw some statistic that there's over 3.2 million buy-to-let properties out there in the private rented sector right now today that would not meet that test. Over 3 million properties. So the first thing is, do you know how many properties that wouldn't meet that test? How many properties in your portfolio are D to G? And if you're shaking your head saying I haven't a clue, well, I'd put it on your action list to understand how big an issue you have. You know, our property asset base in the UK is via country mile. The most common property is the old Victorian terrace house. So it would not surprise me that you've got a number of those, in your portfolio, and they probably don't hit that A to C rating. So once you've figured out how big an issue you've got, then the next question is, what are you going to do about it? And If the answer is that it's going to cost you too much money to drag it into the A to C banding, then you may then be thinking, well, actually, I'm going to have to sell it because I don't want to invest 5, 10, 15,000 quid, whatever it's going to cost to get it up into that bracket. It's not worth it. Well, you want to be selling that property now. You do not want to wait until 2025. I can assure you, as confident as I can be, that there's going to be a glut of properties coming onto the market with the landlords that have put their head in the sand, and assuming this does come into legislation and they find they can no longer let their properties, they can't afford to upgrade it, and therefore they'll have no choice but to sell. And I suspect, they'll end up having to sell at discount as well, because of the supply and demand imbalance that I think will be prevalent come 2025. So what are you going to do about it? That's the question. So lenders are really tuned into this impending challenge, let's call it, for us landlords. So here's two things that they're doing. So green mortgages. I think now pretty much every buy-to-let lender is offering a green mortgage as well as what I would call a normal buy-to-let mortgage. And so lenders are incentivizing you landlords that have already got your property into that A to C bracket. If you have, then that buy-to-let lender will say, well, great, you can now have one of our green mortgages and they're at a slightly lower rate. So you're going to be saving. So there's an incentive right now to not wait until 2025 to do your upgrade, do it sooner, and then the next time you're refinancing, you should therefore be eligible with almost any lender in the country to get a discount on the interest rate. So there's a real incentive to do that. The second element of these green mortgages are not with new mortgages. So if you're going to a lender for the first time, whether it be for a purchase or a refinance, but you're already with a particular lender, and maybe you're locked into a fixed deal for a period of time still to come. Well, most lenders will offer further advances, and equally, more and more, and again, I suspect by the end of the year, every lender will offer further advances at a discounted rate if you can demonstrate that you're releasing money to invest in energy efficiency measures, new boilers, solar, what else might be, double glazing, better lighting, energy efficient lighting, the list goes on, I'm sure. So if you can demonstrate that to your existing lender, then they should offer you further advances at a preferential rate to if you were borrowing further advances for a deposit for your next property, for example. And it's getting quite common now for lenders to offer that. So two genuine benefits where if you can get in that A to C bracket, the rates being offered, whether it be for new mortgages or further advances, will be at a sort of priority. And so the last point on here is to genuinely think about when you're next looking to release equity out of your property. And by the way, I just looked at the nationwide house price index before I came on and did this, and nationwide are saying that property prices in the last 12 months have gone up 12.1% as an average UK house price rise. How have you guys done? Have you gone above average, below average? But hey, that's a double-digit increase. So hopefully there's some, improving equity in your properties. And if you're looking to pull that money out, and historically you've used that to continue to build your portfolio, I would strongly suggest you take a step back and say, look, is it in my interest now, rather than just to keep growing exponentially, I look at the quality of my portfolio and get that looking more healthy. And so I reinvest some of that money I'm pulling out into getting my property into that A to C banding for the reasons I've said. Okay, a little bit on protection, as I always do, a little sort of spotlight for a couple of minutes. And this month, I just want to focus on critical illness. Now, quite often we see that where it's tagged on to life assurance policies. You can obviously have standalone life assurance policies, but it's not unusual to see critical illness included in that policy as well. And so what do I mean by critical illness? So usually, and I am generalizing, there's a list of around 40 different conditions under this umbrella heading of critical illness. By a huge margin, the 3 conditions that are claimed on almost all of the time are cancer, heart attack, and stroke. You know, we probably all know someone that's had that. You know, the stats say, I think it's 1 in 2 of us now who get some form of cancer. So, you know, it's almost part of our lives for sure. So, first of all, critical illness has a list of conditions. And as I said, there's these 3 that are the dominant ones that tend to be the reasons why people might claim. Now, here's why critical illness has perhaps had a bit of bad press in the past, is that behind that condition, that headline, let's say for heart attack, is a definition of what that condition is as far as the insurance company is concerned. So there's a very strict definition. And therefore, if you've had a heart attack, then depending on how severe that heart attack was, it's measured against this definition. And with the traditional critical illness policies, if the severity of your heart attack is here, but the definition on the insurance policy is that bit higher, then it's a simple question for the underwriter at the insurance company. Is it a yes, they can claim? Is it a no, they can't claim? And if it isn't severe enough, it's a no. It's a very black and white, very harsh response from the insurance company if you're wanting to put a claim in. So let's say you've got £100,000 pot of money for the critical illness cover. You're either going to get £100,000 payout or you're going to get absolutely zero. So this is what the more forward-thinking insurance companies have started doing, and really I would say it's driven by advances in medical technology. That the heart attacks you would have had today, you are going to survive. It might be life-changing, might not be actually. They can get in and do certain procedures a lot quicker. The drugs and the medical support you can get means that the impact on your life going forward can be minimized. However, it still can be an impact, and so you still may want to claim. So the newer policies acknowledge the different severity levels. So unlike the old style policies, which said, look, if you don't meet the highest level of severity, then bugger off, you're not getting a penny. These companies say, okay, here's the definitions for the most severe, reasonably severe, and different levels. So for 100% payout, the £100,000, this is what the condition is. For a 75% payout, this is what the diagnosis needs to be. For a 50% payout, for a 25% payout. And therefore, when you claim, irrespective of how severe it is, it's highly likely that you're able to get some sort of payout that reflects the severity of your condition. And that feels fair and reflects the way that medical advances are going, that the impact on your life now is probably not going to be as severe as it would have been a few years ago. But still reflected in the policies. In addition to that, these forward-thinking insurance companies are also recognizing that they want a customer who really actively wants to look after their weight and their lifestyle is a healthy lifestyle. And given we're all wearing smartwatches, we're all wearing Fitbits and other devices that can record our workouts, then these insurance companies are saying, look, record it, upload it, and we'll aim to give you benefits. We'll give you reduced premiums if you're doing a workout regularly, if you're doing so many steps or so many miles or whatever the requirement is. And therefore, yes, not only will we give you discounts on your premiums because it's in the insurance company's interest, because there's less likely going to be a payout, but there's also other benefits thrown at the applicant, the customer as well, in the form of Starbucks coffees and cinema tickets and cheap or even free membership to gyms and that sort of stuff. So if that's something that resonates with you and you want to review your insurance situation, and maybe you've had a critical illness policy in the past, or you've thought that they didn't suit you for the reasons I've said, but actually these new types of policies think they might suit you, and you just want some more information, at the end, I'll just point you to how you can speak to Yvonne, who's our protection advisor, and she can outline it a little bit more, give you some information so you can make a decision whether that is right for you. Which sort of brings me right to the end now, just to cover off the other services that we offer. I mean, and we're talking about buy-to-lets today. Look, we do all residential mortgages as well for clients. We advise on the bridging finance, development finance, auction purchases, commercial, semi-commercial, anything where there's going to be finance secured against a property, then we're more than happy to assist. And right, last slide is, if you want to get in touch, if you want to chat further, look, free reviews, which is always good to have, isn't it? No charge. We'll have a good chat with you. We'll give you the advice. The advice is actually free. It's only if you want to take us up on the advice that we will then sort of charge. So actually the advice is free. And that's for mortgages or indeed protection. Then you can jump onto that link there and have a review with one of the team. They'll be delighted to help as much as they can. If you want more information on the company, you've got our website details below. If you want to understand a little bit more about where we're from, how long we've been around, and what we do, then by all means jump onto the website. If you want to be made aware of bulletins in the future, then there should be a little subscribe button somewhere around the periphery of this video. We're delighted if you want to just click subscribe. And if you've got any comments, you want to just chuck that in the comments box, then that can also inform what we put in as content for you guys for the future. Other than that, I really appreciate you listening and watching right to the end of this mortgage market update for May. Thank you so much, and we'll see you for the next update.